This is a fairly important topic, economic factor influencing investment. So each one of them, like the micro or macroeconomics, fiscal and monetary policies, where it involves the government which rules the country. So you need to have a good understanding, at least at a very high level, what it means, because your return on investment depends on these factors. So you need to have a high level understanding as what they are. Even though this is widely talked on the economic aspects, though investment is altogether a different one. But unless these factors are favorable, your persons or your investment might not fetch good returns, even if it is fixed deposit or even in the stock market. So you need to have a high level understanding as what it is. That's what we are going to see now. So micro versus macroeconomics. What is micro? The word itself says it is micro at a lowest level. How people are made into a country. So how people make choices under condition of scarcity and impact of those choices at an individual level is micro. At a society level is macro. So it could be at the state level. Like some of the states do well in GDP, higher returns in GDP, whereas few states is not doing well. There is a lower GDP as well. That is at the state level, and then comes the country level also. Anyway, people choices is at the micro level, and any commodity, any product, any resource is always generally um, when it has a value, it's there need to be a demand. When it has a value, there need to be demand. It might not be available as freely as possible. If it is freely available as much as possible, then there might not be a demand as well. So it is available in excess. So if you take a step further, if available in excess, naturally there is going to be a kind of a inflation. Money is available in plenty, but it is trying to. But whereas commodity is very less, then yes, it causes inflation. There is a price rise because commodity or a product. Say for example, just basic example. Let's take a bread unit of bread. There is just only one bread, and almost all the people are going to be having 100. I'm just hypothetically giving this example. One bread, all people are having $100. So naturally the person will try to say that this cost $110, even though at a normal time when the finance is going to be distributed, rich and poor exist, it has a value there. The bread value will be there, intrinsic value will be there. But at a lower level, all people are going to uniformly have that money, then there creates a scarcity for a product. Now this is a high level one. So micro, the point is uh, to the people, and when it is society, it's a thing macro level. So same one, micro study a behavior of individual, their decision to buy and consume based on the price turn signal, because when people invest or buy products, naturally production is going to happen. If they are not going to buy, yes, production activity will not happen. Then the economy will be kind of a standstill. So ideally, to economy to grow, people should spend money. That's the basic need in any country. So microeconomics are the theory of a firm, but whereas macro, it's at a higher level, at the country level, or at least at the state level. So extending the concept of individual here deals how the firm adopts to different strategies to increase the profit. Macro, a big picture that is at the country level. Microeconomics focus on the individual household firms. Macro economy as a whole, which could be a state or a country. Macroeconomics, because deals with the unemployment rate, GDP, gross domestic product, that is depends on the consumption, overall price level, inflation, saving rate, investment. So any country, any government focuses on all these things: employment, GDP, price level, inflation, savings, investment, etc. That is what a government has to focus on. If the country is going to have a favorable environment, not just for the people, even for the external people also to invest in the country. So most of these factors, yes, of course, as I said, depends on the government, public policies, and public policy is either the government or it could be the central government. In case of India, it's Reserve Bank of India. So now I think you have big picture about micro and macroeconomics. All this influence macroeconomics influences your investment, the rate of investment. If the country is doing well on the macroeconomics, then yes, the share market is bound to fetch good returns. Various factors in macroeconomics variables. So the factors, the continuous attempt to implement policy which ensures low unemployment rate, which we saw also, price stability, low inflation rate, steady growth in economic, which is GDP, foreign exchange. This is in the last, I would say, 30, 40 years. This is creating, because it's a flat world, foreign exchange inflow, investment, foreign currency or gold reserves. If a country is going to have good foreign reserves, gold reserves, it's a kind of a top country. You look at any country, either they will have high gold reserve or good foreign exchange reserves. So top 10 countries, if you look at it, it will have good foreign exchange reserve or a gold reserve. So that will determine the economic stability of that country. Then comes the fiscal and monetary policies. Who makes what? Fiscal policy is generally by the government. Monetary policy, yes, it's generally by the central bank, but still government has an influence. Fiscal policy contains a measure government deal with its revenues and expenses. Measures and important in any country, because the government changes measure of its income versus the expenditure. How does it generate income? Normally through the taxation, various taxations, and those taxations are spent on the expenditure. Education, healthcare, police, military, interest on the etc. etc. And if they are going to spend on more on building products like different products, you see that, and they are going to export it, yes, then the stock market related to defense manufacturing will go up, even though that's an expenditure or research and development expenditure. This is happening currently in India also. Defense export is growing, and that's where, if you look at it, defense stock is going up. Similarly, on the healthcare, pharma sector, if they are going to export more, naturally the pharma sector shares are going to go up, the price is going to go up, they are going to pay better dividend because they have better profit, dividends are provided. The aggregate demand of this supply, savings, investment, overall economic, this influences, all these factors influences the aggregate demand, supply, savings and overall economic activity in the country. But another point here to understand is fiscal deficit. The expenditure is over the revenue. Yes, there is going to be a fiscal deficit, which is generally a percentage of GDP. You will find now these days, even the developed countries have fiscal deficit. The way they balance is that, US, for example, it does have their debt is much higher. It keeps increasing, but since it has the reserve currency, the USD, it is able to manage well. But whereas a country like India, INR is not a reserve currency. Though it is used in trade, it's not a reserve currency. People don't invest. People from abroad might not be interested to invest in INR. So naturally, it's not a reserve currency. That's where there is always a challenge in maintaining the exchange rate of INR. They have no other option to increase the export. There is a balance of trade. That means your export is more than import, then it is good. But normally reverse happen. Imports are more than exports. Then there is a challenge. Balance of payment happens. So yes, fiscal deficit, as far as the meaning goes, expenditure over the revenue. Expenditure is more, then there is a fiscal deficit. Monetary policy, as I said, it is the central bank which determines that. But again, there is an influence. Sorry, there's an influence of government. How does it controls the money flow? That's through the repo rate at which the central bank lends money to commercial bank, cash reserves ratio, statutory. The last 2 points, that is cash reserve ratio and statutory ratio. If you look at it, when there is a kind of an inflation, the central bank manipulates that. Higher inflation, naturally they will raise the repo rate. They will ask the bank to maintain a cash reserve ratio, higher cash reserve ratio, or the liquidity ratio, higher liquidity ratio. That means they are trying to enforce the money circulation is less in the market. Whenever there is an inflation, you will see that repo rate is increased, which means actually indirectly you'll see the deposit rates, FD rates getting increased. But that also influences the money availability in the market. Free flow of money is arrested by increasing repo rate, cash reserve ratio, or statutory liquidity ratio. So you need to have a basic high level understanding of fiscal monetary policy, microeconomics and macroeconomics. This itself is a huge topic, huge topic. You don't need to go in depth into it, but just from an investment perspective, have a good understanding on how and why it's happened. That's where the country's budget is looked at. Um, is an important topic as well. Country's budget that determines how the investment behaves, or rather, how the stock market also behaves. So that's where the budget in a country is very important. End of the day, it all boils down to fiscal and monetary policies and the macroeconomics of the country, which is done by the government of that country as well as the central bank. Case of India is RBI. In case of US, I think the federal bank will do that. I believe, not very sure. So in case of India, it's RBI. Thank you. Stay tuned.